Two people walk into the same neighborhood 10 years apart. One buys a house for $150,000. The other buys the exact same house for $450,000. Same walls, same street, same city. Nothing about the house changed. So what did? Because if you listen to most explanations, housing prices rise because of supply and demand. Not enough homes, too many buyers. Sounds clean, logical. It's also incomplete. And the missing piece is what's quietly driving prices higher, almost everywhere. Right now, housing isn't just a place to live, it's a financial system. And once you see how that system works, the price jumps stop looking random and start looking inevitable. Let's start with something simple. Imagine you want to buy a house. You go to a bank, they offer you a mortgage. But here's the part most people don't think about. The bank doesn't hand you money that already exists. It creates new money in the form of a loan. Just like that, your purchasing power increases. Not because you saved more, but because the system expanded to let you spend more. Now multiply that across millions of buyers. Every time more credit enters the system, buyers can afford higher prices, and sellers adjust. Because if someone can pay more, why would you sell for less? So prices climb not just because homes are scarce, but because money is more available. This is the first hidden engine, credit expansion. Housing prices don't just follow demand, they follow how easy it is to borrow. Now zoom out. Over the past few decades, something subtle but massive happened. Interest rates kept falling. In the 1980s, mortgage rates in some countries were over 15%. Today, they've been as low as 2 to 3%. That changes everything, because when rates fall, monthly payments shrink, even if the total price rises. So instead of asking, "Can I afford this house?" buyers start asking, "Can I afford the monthly payment?" And banks design the system around that question. Lower rates mean buyers qualify for larger loans. Larger loans mean higher bids. Higher bids mean higher prices. It's not that homes became more valuable in a physical sense. It's that people were allowed to pay more for them. And they did. But here's where it gets even more interesting. Housing stopped being just shelter a long time ago. It became an investment. Think about it. If prices keep rising, owning a home isn't just about living, it's about building wealth. So more people rush in, not just families, investors, companies, funds. They don't need the house, they need the return. And housing offers something rare, leverage. You can control a large asset with a relatively small amount of your own money. If the price goes up 10%, your actual return can be much higher because most of the purchase was financed. That's powerful, and it attracts capital. Suddenly, housing demand isn't just about people needing homes, it's about money looking for growth. And money doesn't sleep. Now add one more layer, governments. On the surface, they want affordable housing, more access, lower barriers. But beneath that, there's a different incentive. Rising home prices make people feel wealthier. When homeowners see their property values increase, they spend more, they borrow more, they feel secure. That fuels the broader economy. So policies often lean towards supporting prices, not lowering them. Tax incentives, low interest rates, support during downturns. Each one quietly reinforces the same direction, up. Because falling home prices don't just hurt buyers, they threaten the entire financial system built around them. And that system is deeply connected. Banks hold mortgages, investors buy mortgage-backed securities, pension funds rely on stable returns. Housing isn't isolated, it's woven into the core of the economy. Which means when prices rise, the system stabilizes. When they fall, everything shakes. So there's a built-in bias, a kind of invisible pressure keeping prices elevated. Now, contrast this with the story most people are told.
You just need to save more, wait for prices to drop, buy at the right time. But those ideas assume housing behaves like a normal market. It doesn't. Because normal markets don't have this level of financial engineering behind them. They don't have money being created at scale to support demand. They don't have global capital flowing in. They don't have governments quietly protecting price levels. Housing does. And this creates something strange. Prices rise faster than incomes, year after year. At some point, it stops making sense on paper, but the system keeps going anyway. Because it's not purely driven by wages, it's driven by credit, policy, and investment behavior. That's why even when people feel priced out, prices don't immediately fall. The demand isn't just coming from them anymore. So where does this lead? Well, there are only a few directions this system can go. Either incomes catch up, which is slow, or credit expands even further, which has limits, or prices stall or fall, which the system resists. None of these are clean outcomes. Each comes with trade-offs, and that's the tension underneath everything. Because the same system that made housing a powerful wealth builder also made it harder to access. So when you see housing prices rising again, and they will, it's worth asking a different question. Not why are homes so expensive, but what is pushing them higher behind the scenes? Because once you understand that, you start to see something uncomfortable. This isn't just a market, it's a machine. And the real question isn't whether it keeps running, it's who it's really built for when it does.